Charlotte McLeod with the Investing News Network, and here today with me is Adrian Day, president of Adrian Day Asset Management. Thank you so much for joining me at PDAC in person.
Well, thank you, Charlotte. It's good to be with you.
It is. It's good to be back in person, as we said. And I wondered if you could just start by telling me a little bit about what you have seen on the show floor, because I've been sitting around here.
Well, as a lot of people, you spend half your PDAC stuck away in rooms and meetings, so you don't really get the feel of a conference. I think there's definitely, the last couple of days have shaken people, no question. But there is an underlying optimism. This industry is always optimistic, even in the depths of a depression. You've got to be an optimistic person to be in gold exploration in particular. But I think there is a sense that, gold is better positioned for the future based on what the Fed is doing. So gold is better positioned. There's a feeling that there's more and more M&A going on. And, obviously all the companies are hoping that it comes down and eventually reaches them. So that's a cause for optimism. And, there's been some interesting developments in the sector. So people might say, well, did you see so-and-so's drill results? They're only 5 miles from us. And so there's a lot of optimism, I think.
Right. And as you said, though, there's the optimism, but then there's the shakiness in the market and there's that volatility. And I think some of it's maybe due to CPI data we got on Friday. Of course, there's other underlying factors, and that's influencing what we might see from the Fed, which is meeting this week.
Yeah.
So maybe you can help us unpack some of those things.
Yeah, no, you're absolutely right. You've got it all. I think there's two things, though. Let's not forget the fundamental backdrop is very, very expensive stock prices. So in the US, stock prices were at their most extreme levels of valuation ever. So we should never forget that. When you have overvalued stock prices, then it doesn't mean they're going to drop anytime soon, but it does mean that there's more potential for them to drop further. And the same when stocks are cheap. Doesn't mean they're going to go up anytime soon, but it means your risk reward is weighted towards them going up. The market is obviously concerned about just how much tightening the Fed is going to do. And the Fed has not only, typically the Fed starts hawkish and starts backing down. This Fed has sort of gone in the opposite direction. And in the last couple of weeks, we've had some significant developments. We had the jobs number, U.S. Labor Department jobs number, which showed, more jobs created than people thought. Well, that gives the Fed cover to raise rates. Then you had the inflation number, which showed inflation continuing to increase. Again, contrary to establishment predictions that we had peaked, the rate of growth had peaked. And so that gives the Fed a cause to continue to tighten. And then the most important in my mind was the meeting between Jerome Powell, chairman of the Fed, and President Biden, when Biden basically said to the Fed, inflation's your number one priority, and then not so subtly said, and of course we respect the independence of the Fed, which basically means it's on you, Jerome. It's not our fault, it's yours. And so if you've just had a meeting with the president where he has told you and then announced to the world that inflation's your number one priority and you're responsible, you continue to be hawkish. And I think that's got the market really nervous because as we've seen, both with stocks already weak and with the economy already showing signs of weakness, Target, Walmart, reduced sales, credit card debt, the largest increase in history last month, the largest percentage increase in history last month. Savings rate back to 2007 levels. So all of the savings that were accumulated during the COVID lockdowns, all gone. And so there's already indications that the economy is slowing. Plus you've got Jamie Dimon saying there's a hurricane ahead, et cetera. And then on top of that, the Fed is ramping up its hawkish talk. That's a recipe for asset prices to go down.
right? And I think a favorite topic that we've been hearing about over the last couple of days, and even beyond this, of course, is do these factors add up to a recession?
I think so, definitely. I've been, last time we talked probably, I was not in the recessionary camp. I was not in the market's going to crash camp. And I may have said that as long as the Fed continues to increase liquidity, asset prices, stock markets will do well. But now there's a reverse. They're withdrawing liquidity. And I'm sorry, I'm answering a different question here. But, if for 12 years we have said, me and other people, we've said, so long as there's liquidity, the market's going to do well. Well, logically, when the Fed starts withdrawing that liquidity, the market's going to go down. And I think we've got a lot further ahead on the market. But on the economy, yes, I mentioned credit card debt, I mentioned savings rate, I mentioned Target, and it's not just Target and Walmart. And I realize Target, arguably they had the wrong things in inventory and all that kind of stuff. Anytime something happens, people can always come up with rationales for why it happened. But the plain fact is, across the board, there were other companies as well that service middle income and lower middle income people, and they are all doing very, very badly. And you look at the consumer, people will say, oh, but the consumer spending is strong. How do you mean strong? Consumer spending hasn't declined, but prices have gone up 10 or 12%. So what they're buying, the volume of what they're buying has definitely gone down.
Right, and
I was just going to say, I wouldn't be surprised if we're in a recession now. The official definition of a recession, as you know, is 2 back-to-back quarters of GDP decline. Well, the first quarter was a decline. There were anomalous factors, but then there always are, right? But I wouldn't be surprised if at least the third and fourth quarter are going to be negative. We're going to be in a recession by the end of the year, I think.
Okay. Thank you for explaining that. I think that the last time we spoke, it was around the end of last year, and one of the things that we talked about was what was going on with gold. And it was, I think we talked about it suffering because of, the uncertainty about what was going to happen with the Fed. Do you still feel like it's uncertain right now?
One swallow doesn't make a spring, and so you've always got to be careful with extrapolating a very short term. I think Friday's action, where the CPI number came out and gold immediately dropped and then recovered sharply and ended the day up. I know it's come down since then, but I think that was very, very positive because it showed that people, gold investors, were finally focused on what the Fed can do, not what they want to do. Now, of course, the last couple of days we've seen gold decline, gold stocks decline, everything decline. That doesn't worry me too much because when you see markets dropping precipitously, people sell whatever they can, right? Just as a tangent, I had to sell someone silver this morning. I didn't want to, but long story short, it doesn't matter what the story was, but I had to sell. I had to raise, it was only $10,000, but I had to raise it. And what can I sell today that's liquid and that I think I can buy? Okay, let's sell the silver. And so everybody sells what they can when things are crashing. And so you sell gold because you can sell it immediately. So that doesn't bother me. If you look back to 2008, you look back to 1987, probably before you were born, but you look back to 1987, in these market crashes, gold stocks actually declined more than the broad market, but they bottomed sooner and they recovered sooner. So you look at 2008, for example, gold stocks started dropping in August. The S&P didn't start dropping till October. By the end of February, gold stocks were back to where they were in August. They had already fully recovered, and the S&P had another 2 months before it even bottomed. So the gold stocks tend to recover sooner and further than the broad market, and I think that's what we're going to see here. So whether it's today, tomorrow, next week, we're going to see some incredible buying opportunities in the gold space, in the next several days or maybe weeks.
Right, and I think that's a key question for people right now. There's lots of people who are wondering, what do I do? It's volatile, not sure what's going on. So that's one space to look to. Is there any other advice you might have?
I'm sorry?
Any other advice that you might? Yes.
Well, let me just say one more thing, which I didn't really say. I mean, you've got a slowing economy and you've got inflation going up, right? I don't think the Fed, I'm not alone in this, I don't think the Fed, there is no way the Fed is going to be able to bring inflation down to a reasonable level without provoking a recession. So what does that mean? High inflation and a recession, that's stagflation. So what assets have done well in inflationary periods? You can go back to 1960 and look at every stagflationary period we had, the most important one, of course, being the second half of the 1970s. And the number one performing asset has been energy, and the number two performing asset has been gold. And gold stocks have done well in every single stagflationary period. So I think I think gold is really where you want to be positioned if you see a stagflation coming. Other things, yeah, I mean obviously the thing you buy assets when they're cheap. You should be buying when everyone else is afraid. Now, I'm certainly not saying, to go out aggressively and buy broad market today, by no means. But if you look around the world and look at good quality global companies that are really super solid, strong balance sheets, with revenue that is unlikely to be affected too much in a recession. So a company like Nestle, for example, which has operations in 100 different countries, so well diversified, super strong balance sheet, and typically their sort of products hold up in a recession. You buy that today or next week or whatever, a yield of 2.5%, nothing to get excited about. But, I think you can start nibbling at companies like that, that are significantly, the stock prices have dropped a lot.
Right, and when we started out talking, you mentioned mergers and acquisitions in the space right now. Does that translate through here with, we maybe will see some of the gold majors buying?
We haven't really seen the majors buying the juniors yet, have we? We've seen the so-called mergers of equal, which always amuses me, because Agnico bought Kirkland. That was not a merger of equals. Sorry, that's a tangent. So we've seen those big companies merging. We've seen a few examples of larger companies buying, well-developed primarily Canadian or Australian assets, like Newcrest buying Pretium. But we haven't really seen yet the junior space, whether they're explorers or whether they're companies that have, made a discovery and are trying to develop something. We haven't seen it there yet. But I think eventually we will, because there's only so many large Canadian deposits available. I mean, when you think that Kinross bought Great Bear before there was even a PEA, that shows you just how desperate majors are to get assets in good jurisdictions. And so I think eventually it's going to trickle down. It has to, because there's only so many of those left.
Right. I think that kind of wraps up my questions for today, but I wanted to ask if there's any other advice you would leave people with during these times.
Yeah, the most important advice I would give is not to panic when things are bad. Yes, of course, we wish we had sold that last week, and we wish we had done this or done that. But where you are right now, the worst thing people can do is panic. Even if you share my view that things are going to be pretty rough for the next couple of years and the market's going to go down more, never panic in a reactive way. Make it a rational decision, preferably when things are looking a little bit better, when we have some up days and you can think a bit more clearly. But that's the advice I would give.
Okay, well, let's hope that people will listen to that. Thanks for coming by to talk about what's going on in the market.
Thank you so much for having me. Good to see you again.
Yes, and once again, I'm Charlotte McLeod with the Investing News Network, and this is Adrian Day of Adrian Day Asset Management.